Welcome back. Now, we are going to look at another diet, which is May 2022. The last one we looked at was May 2023. May 2023. So why is there a one diet gap? Yeah, the reason was that in November 2022, Ican did not ask published. Well, I won't say they didn't ask published. It's still published, right? But the question wasn't preparation of statements. Where is it? The question wasn't preparation of statements. It was something else. So this is it. This is November 2022. So this diet, this was the question. They gave three companies, and they asked you to calculate ratios for two of the companies, Grace and Blessing, for 10 marks ratio. And you are supposed to analyze the ratio for another 10 marks. You're supposed to analyze the ratios. And the C part was blockchain, the type of records that is maintained using blockchain. I sent you a note on blockchain. So the types of records is there because they asked you this particular diet for 10 marks. They discuss the types of records and state two benefits of making use of this technology. Another 10 marks. I think this was an easier diet. So that's why we are not having November 2022. So like I've told you before, your question one would either be what we are doing right now, statements, PL, financial position, equity, or it could simply be cash flow, like they did last diet. I've not seen them asking it back to back like that. So it might not be cash flow, but cash flow might be in your exam. It might not just be quick, the compulsory part. And it could be ratio. Ratio is also part of published, though analysis of that published. So it could be that. Whatever it is, be ready for any of those as your question one. So May 2022. First, we go to the requirement of this question. It says prepare statement of profit or loss for the year ended December 31st, 2020 for 13 marks. Statement of changes in equity for 4 marks. Statement of financial position for another 13 marks. That's 30 marks. I think this was the final diet, May 2022. This is the final diet they asked it for 30 marks. It's not 30 marks again. If you look at the one we solved last diet, it was 25. The diet that was November 2023 also, it was 25 marks. So they reduced it to 25 marks so that they can have some other things they can ask aside from these statements. But this one was 30 marks. So the additional information, which is, of course, you can see that our trial balance balanced. So, fine. Let me glance through the additional information to be sure the ones I know are the ones I don't. So it says finance costs include full year dividend on preference shares, an ordinary share dividend of 2.5 kobo paid at the end of the year. Allowances for doubtful debt are no longer necessary as customer paid as at when due from time to time in the past 2 years. Okay. There's nothing new here because he's talking about dividend and allowance for doubtful debts. Okay. Now they said severely damaged inventory, which cost 790, were included in inventory neutral balance. This will need to be repaired at a cost of 440 before a knowledgeable buyer will be interested to pay 940 at arm's length. Okay. They asked this in November, so this is a familiar additional information talking about damaged inventory. 3, as at the year end, December 31st, 2020, a valuer based in VI in Lagos was contacted by the company to review its land and buildings. The land and building was valued upward by 13 billion, and a certificate was issued to this effect. The board of directors approved the valuation, but it has not yet been accounted for in the trial balance. The valuer advised that the remaining useful life of the assets is reasonably and reliably estimated to be 20 years. Depreciation is on straight line. Okay, so this is talking about evaluation, and they gave us the remaining useful life of the asset, and depreciation is on straight line. Okay, I mean, this is nothing serious. Then they talked about depreciation on plant and equipment is charged at 15%, reducing balance. Okay, this is a familiar terrain. Then they said the multi-user S&P and Sage was bought on September. The amortization is at a rate of 12.5% annually. Okay. This multi-user is talking about an intangible asset, a software. So they bought it September. I mean, knowing fully well that the year end is December, buying an asset in September shows me that we have acquired an asset during the year. So mostly the amortization might be prorated, except if I'm told otherwise. Now, they told me that the amortization is evenly distributed over the year. This statement is powerful. The amortization is evenly distributed over the year. Do you know what this means? This means that you should prorate amortization. You should prorate it. Unlike the previous question in the last diet that we solved, that one, they said that full year depreciation is charged in the year of acquisition and no charge in the year of disposal. That one that we did, that one is pointing to that even when you buy an asset during the year, charge depreciation for the whole year on that asset. Charge depreciation for the whole year. But in this diet, they are saying the amortization is evenly distributed over the year, meaning correct depreciation. Correct. So any asset that you buy during the year, don't charge full year depreciation. Correct. Good. I like the dynamism from diet to diet. I mean, you're learning everything. We're now told that besides software installation, customization, and handling cost of 800, training costs, in fact, it is not the way I've even read it. Besides, I mean, this is just, I don't know what the English people calls this kind of word. Besides, I mean, it's like a conjoining word. So they want to conjoin it from the previous sentence, showing that, okay, we want to talk about something else. So besides what we have been saying earlier, besides what we have been talking about earlier, okay? So software installation, customization, handling. So this 800 relates to software installation, customization, and handling. So the three of them, 800. He's not saying that aside from, that is not the interpretation of this besides. Besides, okay? Besides, it's like, however, different from what we have been talking about earlier, we want to start a new statement, right? So 800, then there's training cost 900, there's consultancy fee 600, there's overhead 500. On the new, were included in admin. So that means all of these were included in admin, all of this. So they included this 800 in admin, training cost in admin, 600 in admin, general overhead in admin. They included all of it in admin. But that's wrong, right? Even though it's okay to include these general overheads in admin, it's okay to include these, no, consultancy cannot be included in admin. It should be capitalized as part of the costs because that's like professional fees. That's like professional fee. Then there's training costs, which is 900. This should not be included in admin. There's customization, which is 800. This should not be included in admin. This should be capitalized. So this 800 and 600 should be capitalized. We are going to remove them. So when we get there, we'll see. Then I said all depreciations are treated as admin. Okay, good. So they are telling us that depreciation should be charged to admin. So the next one said December 30th, 2020, a chartered surveyor valued investment property at 14 billion, and the company uses fair value model in IS 40 investment property. Okay. 6, we're told that current income tax has been estimated to be this 9 billion, and deferred tax provision is to be adjusted in income statement to reflect tax base of the company's net asset of 12 billion less than carrying amount. Okay. I mean, the examiner tried to be more technical this particular diet. They were more expressive with words as far as deferred tax is concerned. Okay. Then the plant held for sale is valued in the trial balance at its carrying amount. Okay. A broker is readily available to buy the plant for 6 billion at a fee of 6%. The sale will take place in January 2021. Okay, that's after the end. Any necessary adjustment is to be treated as cost of sales. Okay. Then that's it. So this 7 additional information. So let's get to it. So funny enough, looking at this additional information, all of it seems something you should all be able to do, everything. So look at it. So the first one, talks about finance costs, that it include full year dividends on preference shares and an ordinary share dividend of 2.5 kobo paid at the end of the year. Okay, so finance costs include full year dividend on preference shares and ordinary share dividend of 2.5 kobo. Okay, so which finance costs are they talking about? This is the finance cost they are talking about. So this 5.5, they are saying that it include full year dividend on preference shares and ordinary share dividend of 2.5 kobo paid at the end of the year. Okay. Now, what do we need to do here? All you need to do is this. The ordinary share dividend should not be in finance cost. Finance cost is interest. So dividend paid to ordinary shares. Dividend paid to ordinary shares is not finance cost. That's dividend paid, and we should not describe it as finance cost. We should describe it as dividend paid, and it should show in the statement of changes in equity. So we need to calculate this dividend to ordinary shareholders of 2.5 kobo and remove it from finance cost. Secondly, they also said that in this finance costs, dividend to preference shares is there also. Well, is it okay for dividend to preference shares to be there? It depends, really. It depends. So preference shares, if they are irredeemable, if the question is so specific that they tell you that it is irredeemable, that means that preference shares we are never paying them back their capital. That means they are similar to ordinary shares. We are not paying back them their capital. They are irredeemable. So they are treated like ordinary shares. So any dividend we pay to those ones will also be treated as dividend paid in equity. It will be deducted from your retained earnings. But when they are silent or they tell you that it is redeemable, we assume that preference shares should be treated as a liability. And because if you look at these preference shares, it has a fixed interest of 15%. This 15% shows that it gets fixed interest. That means we have an obligation to pay interest. And when there is an obligation to deliver cash, that is a financial liability. So these preference shares is a financial liability in this case. So we will leave it there to be finance cost because any interest, dividend we pay to preference shares of this nature is okay to treat it as finance cost or as interest. So for this sentence, that's all we do. All we just need to do is to calculate the ordinary dividend and take it away from the finance cost. So knowing fully well that the ordinary dividend is 2.5 kobo, when I see 2.5 kobo, immediately I would interpret it as 2.5% or 2.5 kobo or 2.5%, just so that I would easily get my figures right. So this is 2.5 kobo per share. So I need to see my ordinary share capital. I know how many shares, what's the number of shares do I have on ordinary shares so that I can know what I'm going to apply the 2.5 kobo on. So in this case now, the value of the share capital is 40,000. The nominal is 50 kobo, which is 0.5. If I want to get the number of shares, I simply do 40 divided by 0.5. That gives me the number of shares. Because this 2.5 kobo is per share. So if I do 40 divided by 0.5, that gives me 80,000 shares. Then I will then apply this 2.5%, which is the dividend, to the 80,000. Let me show you. Let me see. So finance cost. So I need to take away the ordinary dividend from the finance cost. Look at it. I did 2.5%, which is the 2.5 kobo, on the number of shares, which is the share capital, which is 40,000, divided by the nominal value of 50 kobo. In this case, it's 0.5. That gives 80,000. So if I apply 2.5% on that, and you know how to press calculator on 2.5%, 0.025, right? Or you can do 2.5 divided by 100, whatever you get, multiply by 80,000. It gives you 2,000. So the finance cost in the trial balance is 5,500. So I'm removing or I'm taking away this 2.5 from it so that I'll be left with 3.5. So my finance cost becomes 3.5. That's all I need to do in such a way that when I'm preparing my P&L, what will come in as finance cost is now 3.5. Why this ordinary dividend will be presented in the statement of changes in equity as a deduction for my retained earnings. It will be deducted from my retained earnings, being dividend paid to shareholders. Secondly, here, I was told that allowance for doubtful debt are no longer necessary as customers paid as at when due from time to time in the past 2 years. Allowance for doubtful debts are no longer necessary as customers paid as at when due from time to time in the past 2 years. So what do I need to do? What they are telling you here is this, that the allowance for receivables or doubtful debts you have in the trial balance, which is this, you need to understand that this allowance for doubtful debt will always be on the credit side right? Because it's like a net of your receivables. They are not saying that this 2,000, which is allowance for doubtful debts, which is like a provisions that my receivables might not pay. So this 2,000 here in the trial balance, the meaning is that is the allowance for doubtful debt brought forward from last year. Now they are saying that this allowance for doubtful debt are no longer necessary because the customer has paid. That means there's a decrease in allowance now. There's a decrease in allowance. Let me show you. So, you see, as per, I wrote question 2, my level of rounding off like that. So, as per trial balance, it was 2,000. At the end of the year now, is now 0. It's now 0. So, that means nothing, no allowance for this year. So, allowance has decreased by 2,000. This decrease, like I told you in the last question, goes to P&L. This decrease goes to P&L. It goes to P&L. But since it's a decrease in expense, treat it as other income. If it were to be an increase, we'll add that to admin, just like the previous question. If it is a decrease, other income. If I may ask you, I would cancel this. I just want to ask. Let's assume that the examiner in this additional information were told that at the end of the year, the allowance is now 4,000. Let's assume that was what they told us, that the allowance is now 4,000. The first thing is this. That means there's an increase in allowance of 2,000 in this case too. That increase of 2,000 will go to P&L as an expense. While this balance of 4,000 will be deducted from our receivables. While this 4,000 will be deducted from our receivables. In this case now, it's 0. It's 0 in this case. Since it's 0, that means this decrease from 2,000 to 0. So there's a decrease in expense of 2,000 that goes to income. That means we're not going to deduct anything from our receivables since the closing is 0. So you need to master how to create this allowance. We have seen different dynamics. The last one, there was no opening, but there was closing. We saw that closing, you always deduct it from your receivables. While increase or decrease goes to P&L. If it's increase, P&L as an expense. If it's decrease, P&L as an income. That's all about it. Two, this talks about severely damaged inventories, which cost 790, were included in the inventories in the trial balance. These will need to be repaired at a cost of 440. Before a knowledgeable buyer will be interested to pay 940 for it at arm's length. I already taught you this in the first one we solved, and I told you that damaged inventory should be included as part of your inventory at the lower of its cost and net realizable value. It should be included as part of your inventory at the lower of its cost and net realizable value. In this question, they have given us the cost of this damaged inventory to be 790 million. They gave us the cost to sell as 440, and they gave us the net realizable value, the sales price or the selling price as 940. So my net realizable value is simply 940 minus 440. The difference is my net realizable value. I compare that with my costs. I compare that with my costs. Let me show you. So my net realizable value, I told you, is the selling price, which is 940, minus the cost to sell, which is 440. So my net realizable value is 500. My costs, which is 790. So there's a write down because this 790 was what was included in my inventory as we're told in the question. But I'm going to pick the lower, which is the net realizable value. So I will need to write off 290 for my inventory. I have to write off 290 because 790 was included, but I have to measure this damage inventory at 500. So in my trial balance, my inventory was 10 million in my trial balance. So I will write off 290 from it. So I'm left with 9710. This is just the same solution like the one they asked in November, the same. So it's the same thing every day. So if you had practiced this one and that one, there's no way they will ask you again and you will not be able to do this. You should be able to do it. So this is now my inventory balance. The next one, they said, as at the year end, because December 2020 is the year end, a valuer in VI was contacted, and the guy is supposed to review. The guy is supposed to review the land and build. Okay, somebody's asking a question. She says that what if the net realizable value is lower? The examiner will not give you that because that's just so easy. Because you use the lower. You use the lower. So if the net realizable value happens to be the lower, that means you do nothing because the cost is already included. Abi, what did you say? What if the net realizable value is higher? So that means the cost is lower. Yes, I'm not will not give you that. So because that's so easy. That means because you are picking the lower. That means it's the cost that is the lower. And the cost is already included. That means do nothing. That means okay, things will just continue the way they are. Do nothing. Because the lower is already included. So they will not even give you that. And practically, I mean, the net realizable value should be the lower because this asset is damaged. So we don't expect that you would be making a gain from it again. It should be a loss. Nobody will buy it above its cost. It's damaged. So by the time you repair it and all of that, the net realizable value should be lower. But if the cost is the lower, fine. That means you do nothing. Nothing, no adjustment necessary. You just leave it because the lower is already included. Okay, back to note 3. So they engaged a valuer. So what the valuer did was to revalue the land and building upwards by 13 billion. So that means this is like a revaluation surplus, and they gave us a certificate. We're now told that the board of directors approved the valuation, but it has not yet been accounted for. Okay, so they have not accounted for it. So how do you account for revaluation surplus? First leg go to OCI, the other leg will be added to the cost of the asset. That's it. So they said that the valuer advised that the remaining useful life of the land is 20 years. The only reason why they are telling you this is because for depreciation, so that you can depreciate. And the examiner was very magnanimous. He told you that the depreciation is on straight line. They don't need to tell you that because as soon as they give you the useful life, you have to use a straight line method of depreciation. So let's incorporate this revaluation and depreciation on this land and building. Before I go, let me check the cost of the land and building. What is the cost of the land and building? Okay, this is it. Land and building. 62. 62. I'm surprised they didn't separate that of the land. They didn't separate the land from the building. And they said land and building. So the land and building, the fair value in the question, as at the beginning of the year, is 62,000. They revalued it upward by 13 as given in the question. So you'll see it to be added. And don't forget that this one goes to OCI, this 13,000. Then the value of the land at the end of the year, I said land and building is 75,000. Since they didn't separate land from building, they just put everything together. So, and they gave us the useful life. That means we can, of course, depreciate it. So we depreciate it. We do the annual depreciation, which is 62,000 divided by 20 years, which is 3,100. So the only technicality I can see here is that you would have easily done 75,000 divided by 20 years. You will have easily done 75,000 divided by 20 years. So why 62,000 is because I need to depreciate from the beginning of the year. And the cost of this asset at the beginning of the year is 62,000. So this revaluation only came in at the end of the year. It just came in at the end of the year. So it's not even due for depreciation. It's not even due for depreciation yet. It's at the end of the year. So is the value of the asset at the beginning divided by the remaining useful life. That is what I'll calculate my depreciation on. So I get my depreciation as 3,1. So my carrying amount is 71,900. So from this schedule now, I know that my revaluation surplus, I will recognize it to OCI. My depreciation, I will take it to P&L. I think they told us it should go to admin. Then 71,900 being my carrying amount, I will take that to statement of financial position. So that's all I need for the land.
Sorry, can you take that again, sir? Please.
Okay, where each of them is going?
Yes, and I know you mentioned the fair value 62,000. Revaluation surplus is 13,000, which goes to OCI. But
Yes.
again, you said the revalued amount, the fair value, because that one, the fair value said that is at the beginning of the year. So now you not account for 75, is 75,000. If 75,000 is what is accounted for. So why are we not taking 13,000 to OCI? Maybe
Okay.
I'm mixing it up, so I just want probably re-explanation.
Okay. So again, for this land and building, the cost at the beginning is 62,000. This asset was revalued upward by 13,000. That's revaluation surplus. It goes to OCI. And at the end of the year, the new value of our asset is now 75,000 at the end of the year. My depreciation for this year is going to be the cost of the asset, which is the value of the asset at the beginning, which is 62,000 divided by 20 years. So I said the mistake you will have done is that you will have done 75 divided by 20 years. But you cannot do that because the asset, the revaluation only came in at the end of the year. So they revalued this asset in December. So you cannot depreciate on the basis of 75. You cannot consider this 13 yet. So from next year going forward, yes, we can. But as far as this year is concerned, it's 62,000 divided by 20 years. It's 62,000 divided by 20 years. So That gives me my depreciation. So when I deduct this from 75, I get 71,900. So doing this schedule now, I know the evaluation surplus goes to OCI. So I take that to OCI. My annual depreciation is 3,100, which I take to P&L. And my carrying amount is 71,900. Now, what you are also looking at, if I get your question properly, is that you are saying that since 75,000 now is the value of the asset at the end of the year, so why didn't we just take it to statement of financial position? Abi? I think that's what you're saying. But in this case now, it's not going to fly that way because you need to depreciate the assets at the end of this year because there's this cost, there's this 62,000 that has been there, right? That they gave us separately, and we need to depreciate that asset for that year. As far as we need to depreciate that asset for that year. So we get this 3,100. So when they increase the value of the asset to 75, we need to remove the depreciation from it. We need to remove the depreciation from it so that the balance we have left will be our carrying amount as 71,900 in this case. So
Understood now. Thank you. Thank you, sir.
that's this one. That's everything for this one. The next one, they said depreciation on plant and equipment is charged as 15% on reducing balance. So let me quickly resolve that before I go to this multi-user sage. If the asset was revalued 4 months before the end of the year, well, so it means that you will have done additional depreciation for 4 months on that increase. But the examiner will not give you, they don't give such like that. So because the depreciation is because the revaluation was done at the end of the year now. That's why we didn't bother depreciating that increase. If the depreciation was done at the beginning of the year, of course, we will have depreciated. Sorry, I said if the revaluation was done at the beginning of the year, we will have done full year depreciation for that. If the revaluation was done 4 months before the end of the year, so that we will have depreciated the increase for 4 months also. The 62,000 full year depreciation, the increase, it will get his own 4 months depreciation like that. Then the addition will be the total depreciation. Okay. So let me quickly resolve this depreciation on plant and equipment. So my plant and equipment, where is it? Yeah, this is it. It's 50,000. They say I should depreciate it. So, and they gave me depreciation plant and equipment. This amount on the credits. This means the accumulated depreciation on the plant and equipment. So, let me show you. So I have my plant and equipment. The cost of the plant and equipment is 50,000. I would remove the accumulated depreciation, brought forward. I'm left with the carrying amount. Then, since the depreciation is charged on reducing balance, so I will do 15% of 36,125. 15% of 36,125. Then that gives me 5,419. So the examiner was very clear, 15% on reducing balance. So you charge the 15% on the opening carrying amount. So I get 5,419. When I remove this from this 36,125, then my carrying amount at the end of the year is 3706. So from this schedule that you will have done in the exam now, this depreciation go to P&L, while this carrying amount will go to my statement of financial position. That's for that. Going forward, we're told about a multi-sage, a multi-users S&P and Sage that was bought in September. That was bought in September. The amortization rate is 12.5% annually. The amortization is evenly distributed. This one, they want you to rate the amortization. Right. Okay. Then I said, besides, like, however, software installation, customization, and handling of 800, training cost of 900, consultancy fee of 600, general overhead of 850. On this software, we're included in admin. Okay, fine. It's okay to include overheads in admin, but it is not okay to include consultancy fee on that software in admin. We need to remove it from admin. Similarly, it's okay to include training costs on this software to admin, but it is not okay to include installation, customization, and handling of 800 in admin. So we need to remove it from admin. So this 800 and this 600 consultancy fee, we will need to remove them from admin and add them as part of the cost of this software. You add them as part of the cost of the software. So let me show you what I'm talking about. Now, the multi-user, the software, from the trial balance, the cost is 5.7. I hope you can all see it in the trial balance. The multi-user, this one, 5.7. 5.7. The customization and handling, we need to add it. The consultancy fee, we need to add it. We need to reclassify it from admin and come and add it here. It should not be in admin. It should be capitalized. So by the time you add these three together, you have this. So the annual amortization is going to be D71, which is the new cost of the asset, times the depreciation rate. If you just apply that, whatever you get gives you the amortization per annum. We need to prorate it by 3/12. And why am I prorating it by 3/12? Because we bought this software in September. We bought this software in September. Did you see what I highlighted? We bought it in September. And the year end is December. So if you count November, October, November, December, that's 3 months. So, and they told me that amortization is evenly distributed over the year. So you're supposed to prorate. And that is why I'm prorating the annual amortization here. Prorating it, this one. So the cost, which is 7.1, times the amortization rate, I prorate it by 3 months. So these diets, many students didn't get this right. A lot. Because one, the way this statement was constructed, I don't know why they decided to construct this poorly. You need to look at it or even understand this besides, because somebody might want to interpret this, okay, apart from this one, all these other one were in admin or something like that. Whereas that's not what they meant. So, and people just added only this one to the asset and assumed that this one was already inside, something like that. So, and a lot forgot to prorate because they didn't understood the meaning of this evenly distributed. So they didn't know they are supposed to prorate the amortization. So that's also failed some of. So because this workings is like 3 marks in the exam, 3 marks. So they missed, they got like 1 for the methodology, those that show the workings. So 222. So 71 minus 222, we have our carrying amount. So this schedule I've done now, 222 goes to P&L, while this one goes to my statement of financial position. That's all for this one. And don't forget, they said all depreciation are treated as admin. So all the depreciation we have computed here, just take it to admin. Furthermore, he said on December 30th, 2020, a chartered surveyor valued investment property at 14 billion. And the company uses fair value model for investment property. Very straightforward. So that means at the end of the year, because this is December 2020, the value of the investment property is now this. Let's see if there were any opening balance. Yes, there was 15. So it was 15 at the beginning. Now it is 14 at the end. So there is a loss. I think we show the workings here. Investment property. Investment property. So as per my trial balance, 15. At the end, it's now 14. So there's a loss of 1,000. So you can put it goes to your P&L, of course. This 1,000 goes to your P&L. I can add it to admin. Well, this 14 is the value of the investment property that will show in the statement of financial position. Value of my investment property that will show in the statement of financial position. That's all for that. The next one.
Excuse me, sir.
Now we are back to tax. It says the tax at the end of the year is 9 billion. That's the estimate of our current tax. And it also talked about deferred tax. So let me take care of this current tax first. So in this case now, unlike the previous one where they were giving us on over provision in the additional information, this is how it should be. They will have given you a current tax in the trial balance. I'm trying to look for it. If you see it, let me know. Because I can't find it. Have you seen the current tax in the trial balance? I can't find any current tax. It's only deferred tax.
It's just deferred tax, I think.
Okay, good. So that means they have made it easy for me. That means, so this 9 billion, it goes to P&L and it also goes to my statement of financial position. It goes to P&L and it goes to my statement of financial position. So what I was looking for is, for example, if they had given us, let's say they give us current tax like this. What's wrong with this guy? If they have given us, for example, 22. Let's say they gave us current tax. They now put it on the debits. They say 2,000. I was looking for something like that. You will see it in previous diets. So you see, when they give you something like this 2,000 in the trial balance means under provision from last year. It means under provision from last year. And this 2,000, you will have added it to this 9,000. this 9 billion as the case may be, you'll have added it to it in such a way that it becomes 11. That 11 is what goes to your P&L. While this 9 is the liability for that year. That's what goes to your current liability. That's under provision. However, the examiner could put it on the credits. They will give you current tax. Then I'll put it on the credit. When you see it like this, it means over provision. Over provision. That was what I was talking at for that previous diet. Now, instead of putting that over provision in the additional information, it should have been in the trial balance on the credit. This over provision. And this over provision, what we'll have done to it is we'll have removed it from this 9,000. It will have been removed from this 9,000. And when we remove it from this 9,000, we'll be left with 7,000. That 7,000 is what goes to P&L. That 7,000 is what goes to P&L. While this 9,000 is what will still go to my statement of financial position as current liability. But in this case now, the examiner didn't even stress you. He didn't even put anything, nothing. They put nothing there. So no under provision, no over provision. So it's just this 9 billion that goes to P&L, my balance sheet. Then the deferred tax. We were told that at the end of the year, the deferred tax in the income statement to reflect the tax base to be less than the carrying amount by 12 billion. So the tax base is less, or you can say the carrying amount is higher than the tax base, something like that. So for this asset. So that means this 12 billion is the difference between the tax base and the carrying amount. But in this case now, the tax base is less. It's less by this amount. So the examiner wants you to figure out that this 12 billion, you need to first of all identify, is it a taxable temporary difference? Because it's a temporary difference. Or a deductible temporary difference. The examiner really wants you to figure that out. Can anybody here guess? This 12 billion, is it a taxable temporary difference or a deductible temporary difference? Can you remember what you were taught in income tax? Where the tax base is lower than the carrying amount. Is that taxable or deductible? Okay. That is taxable. That is taxable. Or where the
That's
carrying
taxable.
amount is higher. Yes, that's taxable. Or where the carrying amount is higher is the same thing. So this 12 billion is a taxable temporary difference. So when you now have taxable temporary difference, that will result in a deferred tax liability after applying the tax rate. So we need to apply 30% on this 12 billion. That gives us deferred tax liability. So that will give me my closing deferred tax. Then the figure in the trial balance is the opening deferred tax. So the difference goes to P&L. Let me show you what I'm talking about. So in my income tax, first, my current tax, we have established that they gave us only the estimates of 9. So P&L balance sheets. My deferred tax, as per trial balance, which is my opening deferred tax, 4,002. My closing deferred tax, I applied 30% on this 12,000. And I told you that this 12,000 is a temporary difference, specifically a taxable temporary difference, right? A taxable temporary difference. So then it was 4,2 at the beginning. Now it's 3,6 at the end. So it decreased by 600. There's a decrease in liability. That's an income. That's an income. So in my P&L, my current tax expense is still this 9,000. I will net it off against my deferred tax income, which is the decrease in deferred tax liability, is an income. So the aggregation gives me 84. This 84 goes to P&L. You see this 36 is what will show under my non-current liability as a deferred tax liability, 3,006. And that's all for that additional information. So these are constant ones you always find in the additional information. Finally, the plant held for sale is valued in the trial balance at its carrying amount. So the plant held for sale is valued in the trial balance. A broker is readily available to buy the plant for 6 billion. For 6 billion at a fee of 6% of the sales proceeds. And now told us that the sale would take place in January 2021. Any necessary adjustment is to be treated as cost of sales. So this is IFRS 5, non-current asset held for sale. So there was a plan that was held for sale. And I taught you under IFRS 5 that when you have a plant or an asset held for sale, it should be measured at the lower of its carrying amount and fair value less cost to sell. Fair value less cost to sell. So in this case now, the selling price is 6 billion. The cost to sell, if you do 6% of this 6 billion, whatever you get, remove it from, that gives you your net realizable value, right? And in the trial balance, the plant held for sale, I'm trying to look for it. Yes, this is it. It's 7.5. And you will see that the net realizable value will be lower because 6 billion minus the cost to sell already. So let me show you in the workings. So the plant held for sale. So the carrying amount, 7.5. The net realizable value, which is 6 billion minus 6% of that sales proceeds, which is 360. It gives me 5,640. Okay, when I net these two, the difference will give me an impairment loss. I taught you this under IFRS 5. When the net realizable value is now lower, the difference is impairment loss. So this goes to P&L. And the question told us that we should take it to cost of sales. Any adjustment from here to go to cost of sales. So here now, this one will go to P&L, while this will be the value of that plant at the end of the year. Let me show you where they told us to take it to cost of sales. They said any necessary adjustment is to be treated to cost of sales. It's to be treated as cost of sales. And that's all. So I just need to put things together now. First is my cost of sales. In my trial balance, if you check your trial balance, my cost of sales is 140. Here's my trial balance. My cost of sales is 140. There was a write down of inventory of 290. We wrote down an inventory, so we need to remove that. Is it removing it or adding it back? Is an expense. So we'll add it to my cost of sales. Yeah, sorry. So back to my cost of sales. So in my trial balance, it was this. My inventory that I wrote down from cost to net realizable value, is an additional expense. Then my impairment loss, I had that. Then my admin, in my trial balance, it was 26.2. The consultancy fee that was added to admin, I need to remove it from it. The customization and handling and installation of software that was added to admin, I need to remove it. Then my fair value loss on my investment property in note 7, I need to add it as an expense. This one that we got here, this fair value loss, is 1,000. They didn't tell me where I should put it, so I just put it in admin. If you had put it in cost of sales, it's still okay. Nobody will penalize you for that since they didn't tell us. And if you have put it as a separate line item, it's still okay as well. Then depreciation. They said all depreciation should go to admin. So depreciation that we did on building, on plants, and the software, all is added to admin. So I get this one. Then my other income, in the trial balance, there was a rental income of 2,500, discount received of 2,000, and there was a decrease in allowance by 2,000. All goes or comes to other income. Let me show you the rental income and the discount received. This is my rental income, 2,500. Then my discounts, on the debit is discount allowed, on the credit is discount received. So that's why this one is coming as other income, as discounts received. Right? So discount received. And that's it. That's it for that. Then to do my statement is the easiest ever. My revenue from my trial balance, no adjustments to that. My cost of sales from my notes. My other income, 6,500 from my notes, from these notes here, 6,500. My distribution costs, 12,300. The reason I'm adding 3,000 here because I forgot to add discount allowed in my workings. So that's just one of the things that happens in the exam. You have already done and calculated. You just remembered, I did not add this, and just go and add it somewhere else. So this 3,000 discount allowed, I didn't add it, even though I know I could have easily changed it. I just wanted to use it to show you that in the exam, in case you'd forget, you can always come here and update. So then my admin, that is up to date. Then I have my PBIT. Then my finance cost. My finance cost is 3,500. I did that from workings 1. This one doesn't have finance income, so I get my PBT. Then my income tax from workings 8, 8,004. Let me show you this one. This 8,400 here. Okay. Then I get my profit for the year. Then my OCI, my other comprehensive income. Remember that evaluation surplus for the year of 13. So I come here and add it. Then I get my total comprehensive income. The addition of these two, 29 plus 13. Then my statement of changes in equity for this period. Again, these are my items of equity. I get them from my trial balance, especially their opening figures. So they give me the ordinary share capital, the reserve, and my retained earnings. So those will constitute my opening in my statement of changes in equity. So balance brought forward. 40,000, 16,500, 20,000 total. There was no issue of shares for this one, and there was no even share premium, so nothing. However, the profit for the year in my P&L, I add it to my retained earnings. And look at the way that I didn't come and add this 42,334 in my retained earnings, that this is what I added. The profit for the year. 29. Look at the way. Then the dividend, that 2,000 naira dividend, don't forget that I removed from finance cost in note 1. I said, don't put it in finance cost, but rather you should come to statement of changes in equity as a deduction from retained earnings. This is it in action. This is it in action. Then I'm done with this retained earnings. Then my revaluation surplus, you will see I add the revaluation surplus for the year, which is this one. Okay. So, I mean, some student made the mistake of going to add this 42,000, everything, come and add it and call it profit for the year. That's wrong. The profit for the year is this. Okay. It's different from OCI. So the items of OCI will increase your reserves. Mostly in your exams, you find them giving you revaluation surplus. So I have my revaluation surplus, then I add it here. Of course, I'm extending the totals here. So I add everything together. My ordinary share capital, 40, my retained earnings, 43, my revaluation surplus, 33. I get everything.
Sir?
Yes, go ahead, please.
Okay, sir. Apart from revaluation surplus, what other item or items that can still come under OCI?
Okay, so number one,
Case of exam.
in case of exam, it's only fair value, it's only evaluation surplus in case of exam at your level. Okay, in case of exam. But in case of the fact that you ask, so number one, there's fair value surplus on financial assets that are measured at fair value through OCI. So, if you remember, when I taught you financial instruments, there are certain financial assets that are measured at fair value through OCI. So those fair value surplus on those type of assets will come to OCI, right? I think I've never seen it in any of your exams, but that is within your scope. That's the only one. So another one you can have, there's something we call actuarial loss or gain. Actuarial loss or gain under IAS 19, which is beyond the scope of our syllabus here. And there's also return on plan assets, also in line with IAS 19, which is beyond the scope of our syllabus here. Also, there's exchange difference on translation of a foreign subsidiary, which is also outside the scope of your syllabus here. When you have exchange differences on translation of a foreign subsidiary, it comes to OCI as well. And a lot others like that. But for your exams, you will see that the only ones we have seen is evaluation surplus. So let's just keep it that way. So now, after statement of changes in equity, then we do the statement of financial position. I mean, no effort because I'll just be copying figures right now. So land and building is already in my notes, in my workings. I just go and pick it. I've done it already. Plant and equipment in note 5. Multi-user in note 6. Investment property, I didn't write the note, but it was updated to 14,000. Then my current assets, inventory also in notes. And yes, there was a note on this inventory that we did. Trade receivables, 10,000. In this question, there was no allowance. Yes, there was allowance for receivables, but now they say it's now 0. Okay, so that's why we just took the receivables the way it is in the trial balance. And then the plant held for sale from our notes as well. This 5,640. So by the time I add these three together, it comes to 25,350. When I add it to these non-current assets, I get a total of 148,834. I get a total of 148,834. So my equity and liabilities, so my equity first, I've told you severally that I just go and dub the totals here. Ordinary share capital, retained earnings, evaluation surplus. Just dub the totals and come and dump it here. I mean, ordinary shares, retained earnings, evaluation reserve. Then total equity is this. Then my non-current liabilities, my 50% preference shares, 13,000. I put it here, right? My deferred taxation, and you know where I got this 13,000 from? From my trial balance. This one. And look at the way I treated it as liability, consistent with the fact that I told you that the dividend should be left in finance cost because it's a liability. So I'm treating the principal amount itself as a liability, 13,000. So that's that for the 15% preference shares. Then the deferred tax is 36 for my workings 8B. This one, 36, this 36 here. That's the closing deferred tax liability arising from taxable temporary difference, 36. Then my current liabilities, my trade payables for my trial balance, my bank overdraft for my trial balance, my current tax, 9,000 for my workings 8A. That one they give us in the additional information. So when I add these three together, I get 15,500. So this 15,500 plus my non-current liabilities of 36 and 13,000 plus my total equity gives me this 148,834, which is exactly the same thing as my total assets, which is 148,834. The same thing. So it balanced. Again, in the exam, if it doesn't balance for you this way, don't even cringe. Don't even bother. Just continue to the next question. I'll stop the recording so you can see on my laptop.